Here in Chapter 2, we're learning how to calculate depreciation. But now in this video lecture, let's take a look at the tax forms that report depreciation. Back in Chapter 1, we learned to prepare a Schedule C, that's for a single or sole proprietorship. And here at the top would be the different types of income less the cost of goods sold. And then we minus out the deductions here to get the company's gross profit or net profit. Now, one of the expenses is depreciation and depletion. Let's take a closer look at those lines. Here is depreciation, including the Section 179 immediate deduction and bonus depreciation and the maker's depreciation all squished together here in line 13. Line 12 would be the depletion expense, and if you had any amortization for this business, it would be included here in line 27 with other expenses itemized out on a separate list. Now, you're going to prepare basically an income statement. Again, here is the revenue, and down here's all the expenses, and you're going to get the company's profit down here. You don't have to prepare a balance sheet, but in real life you're preparing financial statements or at least a trial balance. But what you're reporting for a Schedule C is basically the income statement. Now, if you're preparing a corporate tax return, that's on a Form 1120, again, you have all of the different types of income, minusing out the deductions to get the corporation's taxable income or net profit. And again, one of the deductions would be depreciation, depletion, and here other would be amortization. But for a corporation and also for partnerships, both of which we'll see near the end of the semester, you have to prepare the company's balance sheet and report that on the tax return. So here is a Schedule L for corporation, a balance sheet. And all of us know the assets are equal to the liabilities plus the equity. And the assets would be these ones we had learned in this chapter number 2. Let's see if I can zoom in here. Here in line, I don't know if you can see my mouse, line 10A, the building and other depreciable assets. That would be the real property and the personal tangible property. Here in this column, you would have in line 10A the initial basis. But then as you depreciate it over the years, here in 10B, the next line down, would be the accumulated depreciation. And if you take the difference between the two, again, I don't know if you can see my mouse on the screen, I'm pointing to the next column, would be the book value, or what we learned in chapter 2 would be the adjusted basis of those assets. Likewise, in line 11A and B, you would see the cost of depletable assets less the accumulated depletion. Also, line 13A and B would be the intangible asset initial basis minusing out the accumulated amortization. And again, the difference would be put in this right-hand column, the adjusted basis added to all the other assets of the company. Notice in line 12, you have all by itself the land costs right here in the right-hand column. And you're not subtracting out any accumulated depreciation for land, because we all know you cannot depreciate land. It just sits there forever until you sell. You get rid of that land asset. Okay, let me zoom back out here on our Schedule L. Again, you're going to have a balance sheet at the beginning of the year, and again changing to the end of the year balances. This is also true for a partnership tax return that you see here on this slide on a Form 1065, a partnership income tax return. Again, you have income, and you minus out deductions, but the type of income you have here and the type of deductions you have below are called ordinary business income and deductions to arrive at this ordinary business income or loss. Now, not all the partnership's income is reported here at the top, and not all the deductions reported below. For partnership purposes, certain types of income and deductions are not grouped on this first page of the 1065 form, but have to be allocated to each partner individually because there are certain limitations for those income and deductions. Again, notice you have depreciation here, but possibly not all the depreciation is going to be reported in this line 16A. For example, we learned in Chapter 2 the Section 179 deductions have limitations, and those limitations not only apply here at the partnership level, but also apply at the partner level. So each partner has to know their amount of the Section 179 deduction to apply those limitations. So this bottom line here, the ordinary business income of the partnership, is going to be rewritten on a schedule for this 1065 called a Schedule K. And here would be the same amount. And if you look further down, you can see other types of income that are going to be reported to the partners. And here is a separate deduction we learned in Chapter 2, the Section 179. This will be for the whole partnership. Now all of these items here have to be allocated to the partners, and each partner is going to report it on their individual return subject to limitations, including the 179 limitation we learned in our current Chapter 2. So here's the form to report the amount of the depreciation, a 4562, and you can see it's divided up into different parts. So let's focus on the first two parts, part 1 and 2. So part 1 is to calculate that Section 179 deduction. So you go through all of those calculations we learned in Chapter 2, ultimately coming out to a maximum of $1 million, possibly smaller. And we also know there's limitations based upon the company's income. And there may be amounts being carried over to the following year or carried over from previous years. Here, carried over from previous years to the current year, 2018. Okay, so that's part 1. And then part 2, at least this first line here, would be the bonus depreciation we were talking about in this current chapter. Again, the calculations would have to be done on some type of worksheet that's not part of the return. Okay, and the main thing in Chapter 2 we were studying is the maker's depreciation. So let's take a look at the next slide, focusing on part 3. So here for part 3, the main thing is the calculation of depreciation for new assets that we placed into service during 2018. So some of the terminology here, the so-called class lives, should look familiar that we've seen in our textbook. And we would indicate the date it was placed into service. That'll determine, remember the convention, is it a half-year convention or mid-quarter convention? You can see the here for mid-month. That's automatic for real estate that's depreciable. You have to indicate the initial basis here, and then the recovery period probably will be the same as what you see over here, although the taxpayer can elect to have a longer period in which the asset is depreciated. The method, basically it's going to be the double declining balance method, or they can choose the 150% declining balance method, or they can choose the straight line method. There's no choice here for real estate, right? It's all straight line. So we would take the basis and multiply it by some type of rate. I wish they had a column here for the rate to get the depreciation for the first year. for, in our case, 2018. Now, if you're trying to calculate the depreciation for assets that you purchased in a previous year, you have to do that on a separate schedule. It's not reported directly, the calculation, directly here on the form 4562, but you would do it on a separate worksheet and then total up all of those previous year assets, their depreciation, and report it right here as one lump sum figure. In fact, eventually all of this 2018 calculations will be done next year's return on a separate worksheet and then just lumped together in a previous year's amount, asset amount, yeah, for one figure for previous year's assets being depreciated for the current year. Okay, next part, listed property is coming from the back side of this form. So let's take a look at that. Here's page 2 of the 4562. Remember, listed property is where the asset has both business and non-business use. And the key percentage, let's see if I can zoom in here. My pen doesn't work when I zoom in, but here it's in line 26 and 27 mentions 50%. Yeah, really should be more than 50 to treat that business portion using the maker's calculation. Otherwise, if it's 50% or less, then you have to use basically straight line with a straight line you can see here in line 27 with a longer life. And they ask you a lot of questions regarding the nature, the personal use, to make sure you're following the correct rules here. Now at the very bottom of the backside of this form, part 6 would be the calculation for amortization. And just like the maker's depreciation, they're basically asking you only for the 2018, the new amortizable assets. And anything being amortized that was incurred from a previous year, that's now being amortized in the current year, is put into this line 43. And again, the total would be an other type expense reported back on the main form. Let's move on to the next one. So besides tax returns, you got to have working papers, just like the income statement, balance sheet, trial balance, general ledger, and maybe a subsidiary ledger for your fixed assets like building and equipment. Will be something like this schedule you see here with a description of the assets, the date you purchased it, what's the initial cost basis, how you're depreciating the asset. Looks like in this example we took a 179 bonus for the whole thing. So there's no regular maker's depreciation. Yeah, everything's depreciated upfront in the first year. But if we did do makers, here would be the method. Here would be the class life. And then the rate for the current year. Again, we don't have any because we already took the bonus or the 179. And you would get the total depreciation for the current year that you now would report back on that form 4562. Hawaii has its own depreciation rules. So you could have a separate schedule like this for the state. You probably also have a separate schedule to calculate depreciation for AMT purposes. Maybe something called earnings and profit purposes. Different methods of calculating depreciation for different reporting or different tax purposes. And thank God we have computers yet to help us do all of this type of record keeping. And for Hawaii, if you buy, here it says capital goods, but basically it's a tangible personal property. In addition to depreciation, the state, the Hawaii tax department, will give you a 4% credit. It's almost like paying you back the general excise tax you had paid on that equipment you had bought. You need to meet some conditions though. Okay, let me stop here. We've just reviewed some of the tax forms that you may have to fill in when you report a taxpayer's depreciation, depletion, and amortization.